Hi, Norman Hallett here with your next 4-minute drill for traders. For the next few 4-minute drills, I'd like to cover in detail the most important facets of successful trading, and that's money management and capital preservation. It's interesting how most new traders rank the importance of money and risk management much lower than experienced traders do. To the new trader, defending your capital seems counterintuitive when you're engaged in risk activity. And trading the markets is all about risk then reward. But as you evolve as a trader, you realize that you need to maintain your strong base. And when I say strong base, I mean your capital base and your mental emotional base. You see, losing money on a consistent basis guts your positive attitude as a trader and leads you to a vision of doom in your trading rather than a vision of riches. And as you know, you move in the direction of your most predominant thoughts. So it's imperative that you maintain a positive expectancy in your trading. Okay, enough background. Let's get to the first of the general rules of money management and capital preservation. And there are 10 or 15 of them in total, but I want to cover the first one right now. Okay, the first one is risk only a small percentage of total equity on each trade, preferably no more than 2% of your portfolio value. Now, generally, whenever I talk to traders about limiting the risk on each trade to 2% or less, one particular question comes up. If you have a very small account of $3,000 or $4,000 or $5,000, it's hard to find situations where you can limit the risk on a trade to only 2% of equity. The answer to this dilemma is to trade short-term time frames, meaning trade the 5-minute bar charts or the 10-minute bar charts. On the vast majority of technical trading systems, it doesn't matter what time frame you trade. The technical truths are still valid. What you can't do is compromise your commitment to risking more than 2% on a trade. You need to find a way to make this happen. Now, for some of you that are more experienced in your trading, and you've run, say, a trading plan, real money, successfully for a year or two, you may be able to convince me to stretch that number to 3%. But that would be it. New traders, don't take that statement as permission for you to take a maximum of 3% risk on a trade. For you, the number is 2% of your total equity on each trade. One of the main reasons you need to keep your risk reward very low is that although infrequent, you will experience 5 or 6 losses in a row. Look, when you back test a trading system, one of the things you look for is maximum consecutive losses. Most systems, even the great ones, will show 5 or 6 or 7 losses in a row that would have occurred if you had traded it. So you must prepare for that. Why? Because when it does happen, and it will, your confidence will take a hit. And if you've limited your losses to 2% on each trade, then you're going to take a 10 or 11% hit maximum on that series of losses, and you'll be able to easily overcome that hit in your confidence. A simple raising of that risk tolerance to 4% per trade would mean 20 or 25% in that hit, and you would send your confidence tumbling, which almost always leads to revenge trading or panic trading as you desperately try to recoup your losses. You must not put yourself in that situation ever. So, although it may take an adjustment to your trading plan to satisfy my 2% rule, I believe it's an adjustment you need to make right now. Okay, that's it for this edition of 4-Minute Drill for Traders. And in the next few weeks, we'll be zooming in on more of what you need to do to manage your risk and preserve your capital. I mean, what good is being a disciplined trader if you're running a plan that allows for huge drawdowns? In trading, as in basketball, the best offense is a good defense. So until next week, stay disciplined.